Hello. In this video, we'll continue our discussion of the tax consequences of corporate distributions. This is problems 4 and 5. Now on the screen in front of you have problem 4. Problem 5 will come up after we finish problem 4. You'll see that the facts of problem 4 are very similar, but there is one change, one number, or one fact that changes, and it's going to make a huge difference. Now before you go through problem 4, it's really important that you look at the other problems because these problems are meant to go through in sequential order. So please, if you have not yet gone through the previous problems, please make sure to do that because there will be some summarizing of concepts and whatnot that I did in the previous problems. And again, each problem has some type of new element, new twist to learn, and really it helps understand by developing from the first problem. So here, Kiwi owns all the stock of Fruit Sushi Inc., which is a C corporation that creates this delicious fruit sushi. Kiwi's basis in her stock is $24,000. Assume that after several years of operation, Fruit Sushi Inc. has accumulated earnings and profits, also known as EMP, of $36,000. That's positive $36,000. Now, during the current year, which is going to be the year at issue, Fruit Sushi Inc. loses $32,000, which is measured by EMP. Now, that $32,000 loss was lost equally throughout the year from ordinary business. Now, in addition to losing money, the following other events occurred during the year. And we're going to go through this, and you're going to see it's going to be important to go through in chronological order by dates. You're going to see it's going to be very important. So April 1st, Fruit Sushi distributes $40,000 cash to Kiwi. On July 1st, Kiwi sells half of her shares to Strawberry for $50,000. And then on December 31st, Fruit Sushi distributes $20,000 to each Kiwi and Strawberry. So like we saw in previous problem, Kiwi owns all the stock at the beginning. Halfway through the year, Kiwi sells half the stock. And at the end of the year, Kiwi and Strawberry both get distribution. April 1st, Kiwi's the only one that gets a distribution because Strawberry doesn't own. So we're looking at the tax consequences with respect to Kiwi, Strawberry, the two shareholders, and Fruit Sushi. So remember, whenever we have a distribution, right, we have distributions. Distribution. We have to determine if that distribution is a property/cash distribution or it's a stock distribution. And Code Section 317 is what deals with that specific issue. It states that if it's a stock distribution, then it's not going to be under the rules, the normal distribution rules of Section 301 and 311 and 312 and 316 and 317. It's going to be under the stock distribution rules, which you'll learn more about in later problems. But this is a property distribution. Property has been defined broadly, includes cash, property, again, in the broad sense, and also securities, but again, not securities in the corporation that's doing the distribution, which here is Fruit Sushi, which is not what we have here. Here it's a cash distribution. And remember, whenever we have a cash distribution or any property distribution, we have 4 steps, right? A 4-step process to identify. And whenever we have specifically a cash distribution, step 1 and step 2 are always going to be no consequences. There's no consequences. So recall at step 1, we have to determine the tax consequences to the corporation distributee, with respect to the tax consequences of the distribution. So corporation tax consequences with respect to the distribution, well, there are no consequences when there is a cash distribution. That's because, remember, the basis of cash and the basis of and the amount of cash and the basis are always equal. You don't have any discrepancy with that. So you'll see in later problems where it's a property distribution, there's some type of inherent gain going on, then you'll see that the corporation will have to recognize potentially gain, and you'll see what happens if there's loss. Step 2 is that if there is step 1, we have to adjust current year EMP. Which, what is the current year EMP here? It's negative $32,000. It's negative $32,000. But that's from step 1. We only adjust with respect to step 1. But remember, since it's a cash distribution, there's no consequences in step 1, so that means step 2, there's also no consequences. So again, and I know we've gone through this in the past cash distributions, step 1 and 2 are always no tax consequences. So really, it's important to go ahead and go through step 3. So we go to step 3. And within step 3, and this is where the heart of the analysis with respect to distributions lies in the 4-step process. In this 4-step process, the heart is really in step 3. And we're going to determine the tax consequences to the shareholder. So the shareholder or shareholders like we have here, we have to determine the tax consequences. And here we have 2 shareholders, Strawberry and Kiwi, that receive distributions. So we have to go through and analyze with respect to both. Now within step 3, we have 3 sub-steps. 3 sub-steps. And then within those 3 sub-steps, one of the steps is a 3-part waterfall. So it's really the 3 of 3s. Okay, it's a good way to help you remember it. So those sub-steps within step 3, so first we have to determine the amount of the distribution. We have to determine the amount of the distribution. And if you recall, the amount of the distribution is the amount of cash plus property, the fair market value of property, minus any liabilities that have been assumed by that shareholder with respect to the property. Well, we don't have any property here or any liabilities being assumed, but we do have cash. So the amount of the cash is the amount of the distribution. So on April 1st, Fruit Sushi receives $40,000. So the $40,000 is the amount of the distribution. On December 31st, each Kiwi and Strawberry, they each receive $20,000. So they each get a distribution of $20,000. That is the amount of the distribution. So that's what we do in determining the amount of the distribution. Now the second sub-step is to determine EMP, and you need to determine EMP for the 3rd step, which the 3rd step, we actually apply the specific rules, or apply the 3-part waterfall, which that's why we need EMP. We need that for the 3-part waterfall to classify the first level of the waterfall. We apply the 3-part waterfall, which is under section 301 for distributions. So we're going to be doing all of that. Now I'm going to give us some room, okay? And what I'm going to do is I'm going to give us some room because we're going to go through, we're going to do steps 2 and step 3 together. So the reason that we do step 2 and step 3 together is when we look at EMP, you have to look at the total EMP with respect to analyzing it. You have to look at accumulated EMP and current EMP. You have to look at both. So what is the accumulated EMP? It's 36,000. What is that's the accumulated. What is the current? It's negative because it's lost, 32,000. So the accumulated EMP is 36,000. The current EMP is a negative 32,000. So we have a positive accumulated EMP and a negative current. So this is a new situation. We saw in the previous problems what happens when both are positive. We saw when accumulated EMP is negative and current EMP is positive. Now we're looking at when accumulated EMP is positive but current EMP is negative. And what happens? Well, you might think, okay, well, we can just net these 2 numbers. Okay? And if you did that, we would have a positive 4,000, but how exactly would you apply that? That's one possibility. I'm not going to say whether that's right or wrong. I'm going to tell you what the right answer is in a few minutes, but that's one possibility. We can net the numbers. I'm going to tell you that's not how we do this. And the reason that's not how we do this is because you might recall that when we learned about accumulated EMP and how it works before, accumulated EMP is applied on a first in, first out basis, and these dates might have something to do with it, so I'm going to show you how to specifically apply. But that's one option. By the way, if accumulated EMP and current EMP are both negative, then you can net them and you have negative and there's no EMP. But again, we need number 2 to determine the EMP, the total. So we have to go through the specifics. And I'm going to tell you what to summarize. But really, Accumulated EMP is going to be applied on a FIFO basis based on the dates. We have to go by date, April 1st, July 1st, and December 31st. So accumulated EMP is FIFO because that's positive, and that helps, or that goes into the determination of number 3, the 3-part waterfall. And then current EMP is negative, and what you're going to do is you're going to, since it's ratable or ratably throughout the year, right? We're told that it was lost equally throughout the year. What you do is you have to prorate throughout the year. So to summarize, accumulated EMP is going to be on a FIFO basis, but current EMP, since it happened, and this is important, equally, since it's equal, it's going to be pro rata in terms of how the negative is allocated out. So if you're having trouble understanding that, we're going to go through each date together, and we're going to go through each thing, and I'm going to show you. So now I'm going to give myself some room here and clean this up a bit, so that way, you know, it helps us understand with respect to these distributions. All right, so let's go ahead and let's first start with, in chronological order, April 1st distribution to Kiwi of $40,000. So we have $40,000 distribution to Kiwi. That's going to K. Let's put a line here because we're going to be doing multiple events later on as well. So we have a $40,000 distribution. That's the amount of the distribution. So the question becomes, how much of that goes to EMP? That's number 1, right? EMP, which is the dividend. Number 2, which is return of capital. And then number 3, which is capital gain distribution. So that's really what we're trying to do. Now, that's our 3-part waterfall under section 301. In order to do this, we have to first determine what is the EMP on April 1st. And again, when you have positive accumulated EMP and negative current EMP, again, it's really important. Then this is what you need to focus on. Positive accumulated EMP and current negative current EMP. You have to look on how the EMP was lost. Was it lost equally throughout the year, or was it specifically attributable to an event? So you'll see in problem 5, that's what's going to change. What happens if it's attributable to an event on a specific date, or what happens if it's lost? So here it's lost equally throughout the year, so we're going to apply current EMP as a negative pro rata based on the date. So this one's April 1st. The accumulated EMP, though, is FIFO, so the first in time is the first one that gets to use the EMP. That's just how it works, as we saw from the previous discussion. So we're going to, let's put a line here. We're going to need to determine how much accumulated EMP, or how much total EMP is on hand. And the way to do this is because the, well, we have a $40,000 distribution, right? There's $36,000. So we're going to go ahead, and the way we calculate this, again, because accumulated EMP is FIFO, and this is the first one, our accumulated EMP, EMP, is going to be that $36,000 because that flows over, and again, FIFO. The current EMP is going to be a calculation, and that calculation is going to be the $32,000. It's going to be the $32,000, but only up until, sorry, that's negative $32,000. It's a negative $32,000, but only up until April. So on this day, you got to count out how many months have actually occurred during the year. 3, right? January, February, March. This is a calendar year corporation, right? That's what's going on. So 3 months have occurred. So if you do 3 over 12, right, which is 1/4, that means that there is negative 8,000 of current EMP that has actually taken place as of April 1st, because it all again happened equally, so ratably. So that means the total EMP that's available is 28,000. 36 minus 8, because current EMP is negative, is 28,000. That's an arrow, sorry about that. So again, that's negative 32,000, right, for the total year, times 3 months out of 12 months, because January, February, March, because we're on April 1st. So we have 28,000 of EMP. So that means that the first 28,000 is going to be considered a dividend because it's to the extent of EMP. So that means next right? We have 40 minus 28. There's 12,000 remaining because these three numbers need to equal 40,000. So we have 28,000 here. So these two numbers need to equal 12. 40 minus 28 is 12. So now for return of capital, we look at the basis, which is $24,000 as of April 1st because we haven't yet sold stock. So that means that the next 12,000 is return of capital. And 28 plus 12 is 40. So that means capital gain distribution is 0 because these three numbers need to equal 40,000. That means that we need to determine the basis left over for Kiwi on this date. So we started with 24,000. 24K is the starting basis, 24,000 minus 12,000 because that's return of capital because that comes from basis. So that means that the basis remaining is 12,000. So Kiwi's adjusted basis in the stock is $12,000 at the end of this transaction. So the tax consequences to Kiwi on April 1st, 28,000 is dividend, 12,000 is return of capital, and there's 0 capital gain distribution. Now, by the way, the accumulated EMP has been reduced to 0. Accumulated EMP starts over immediately after this transaction. Accumulated EMP is now 0 because we netted with the current EMP and then we use the remainder. We use the net portion. So that starts accumulated EMP as of the next transaction. So that's very important to understand. And then the basis left over and the 100% ownership is 12,000, which is going to be important for the later discussion for the next date. Okay, so now let's continue to the next date. So we just did April 1st for step 3. Now we're going to July 1st. July 1st, Kiwi sells half of her shares to Strawberry for $50,000. The tax consequences of Strawberry is that Strawberry purchases shares of stock for $50,000. So that's the basis of Strawberry, which we need that for December 31st. But that really doesn't have a tax consequence impact on that date. But it does have tax consequence impact on that date to Kiwi because we have a sale. So we're looking at on July 1st, the sale, this is a sale, not a distribution, $50,000 for half of the stock. So that's $50,000 to K. Okay? So we apply our section 1001 principles. We have amount realized minus our adjusted basis. The amount realized here is what Kiwi's getting, which is the $50,000 of cash. The adjusted basis is the basis of the stock after or as of this date, which is 12,000. But be careful, the 12,000 is the full 12,000. So this is the 12,000 that this comes from April 1st after that transaction, but Kiwi's only selling half. So this is times 0.5 for half, times 0.5, which is 6,000. So the adjusted basis is going to be 6,000. So that means that Kiwi is going to have a gain of 44,000. That gain, since it's a sale of stock, is a capital gain. And because Kiwi's held that stock for several years, right? Several years because Kiwi was around since the beginning. This is going to be long-term capital gain. Now the remaining basis, the remaining adjusted basis to Kiwi is 6,000. That's the Kiwi. The basis to Strawberry of the half of the shares is what's purchased under Section 1012, which is $50,000. So that is the tax consequences for July 1st. Kiwi has $44,000 long-term capital gain, and the basis remaining in the half shares is 6,000. Okay, so now we are finished with July 1st. So now we go to December 31st, where we have some interesting things to consider. Now remember, the accumulated EMP is still 0. Accumulated EMP is still 0. Current EMP was always negative. So that means that on 12/31, we have a distribution of $20,000 to Kiwi and Strawberry. So 20,000 to K. And then 12/31, 20,000 to S. Okay, well, because accumulated EMP is 0 and current EMP is negative, there is no EMP. So in terms of allocating EMP, EMP is 0. Because remember, we used up all the positive EMP in the first one. And then current EMP has always been negative. It's always been negative. So there's no EMP. So that means the next portion goes to return of capital. How much basis does Kiwi have in the stock? 6,000. So we can only do return of capital to the extent of the 6,000. Okay? Finally, number 3, which looks like we're going to actually hit here, this is one of the first times that we see this, is the capital gain distribution. So this is a capital gain distribution, and it's whatever's left over. Because remember, these numbers need to equal 20,000. So the capital gain distribution is 14,000. We're not done because we have to determine the tax consequences with respect to the capital gain distribution. We know it's capital gain, but how is it long-term or short-term? It depends on how long the stock was held. Where those half shares that are there, they've been held since the beginning for several years, so it's long-term capital gain. Long-term capital gain. And the adjusted basis to Kiwi, we started with 6. We subtract away whatever's in that return of capital area. So that means the adjusted basis is 0 to Kiwi. 0 left over. Because Kiwi still has shares of stock. Just because you have a distribution, it's not a stock distribution, it's property. Kiwi still owns half the shares of the stock. They have a basis now of 0. So if anything happens after this, there's going to be no return of capital. It's going to be EMP and capital gain distribution. See how that works? Unless Kiwi contributes more money to the corporation and increases that. So the tax consequences on December 31st to Kiwi, they're going to be no dividend, 6,000 return of capital, which is not tax, but that lowers the basis down to 0, and then 14,000 long-term capital gain distribution. See how that works? Okay, now we go to Strawberry. Strawberry has $20,000 distribution, just like Kiwi did on 12/31. So we first start with EMP. Well, again, this is the same thing. Accumulated EMP was 0 on 12/31 for both. It was 0 after this transaction on April 1st. And because current EMP is negative, that means that EMP is going to be 0. There is no we just put 0 here. It's actually technically negative, just so you know, but it doesn't matter if it's negative. What matters, the negative EMP, that's going to affect step 4. But for step 3, if EMP is negative, we just say, okay, EMP is 0, so the dividend is 0. We're basically saying 0 dividend. 0 dividend because there's no EMP. That's what I'm trying to say. So yes, EMP could be negative because we still have to allocate that negative current EMP pro rata, but I'm saying there's 0 dividend. So then we go to the next step, which is step 2, return of capital. We're working our way down the waterfall. Now, Strawberry has a lot of basis, $50,000. That's a lot. That's greater than 20. So that means all 20,000 is return of capital. And none is capital gain distribution. Capital gain distribution, number 3, is 0. So that means that all of the $20,000 is return of capital, but we still have to determine the basis for Strawberry's stock after this transaction. The adjusted basis started with 50,000 minus 20,000. That equals 30,000. So Strawberry, that K for 1,000. Strawberry's basis after this transaction is 30,000. So again, the tax consequences to Kiwi, 6,000 return of capital, 14,000 long-term capital gain distribution. But for Strawberry, all 20,000 is return of capital, and the adjusted basis of Strawberry goes from 50 down to 30 because there's 20,000 return of capital. So we've just gone through the tax consequences for, with respect to the shareholders for all the dates. And the summary, you see all the summary here. So now we have to go to step 4. Okay, we have to go to step 4. And really, remember that with step 4, what you need to know from step 3, when you have a cash distribution, is the amount, whatever amount was considered a dividend. That's what matters, dividend. So look on here. Look on step 3 for a second. And do you see anywhere on here where there was a dividend with respect to any of these transactions? There was no dividend on 12/31, right, to either Kiwi or Strawberry. On July 1st, we have a sale of stock. There's no dividend there. We do have dividend, though, on April 1st, 28,000. So I'm going to keep this over here, this information here on the left, the April 1st, because that's the only dividend we have. And I'm going to erase all the rest of this, and we're going to do step 4 over here in this area, okay? All right, So as you recall, step 4 is our last step. And what we do in step 4 is we adjust accumulated earnings and profits. And that's going to be very important because we need to know what is the ending accumulated earnings and profits, because that is what rolls over to next year. Because if you were given a problem of multiple years, you would have to know what the adjusted accumulated earnings and profits is for the first year to roll over to the second year to do all this determination. Now, we use a formula. We have a formula, right? And we always start with our accumulated EMP that we're given in the problem, what we have, if you roll it over from the previous year. So it's at the beginning of the year. So here, that's $36,000. So that's what we start with. That's our starting point. Then we add or subtract the current EMP for the year, which here, what is our current EMP? And this is before step 2. This is before we do step 2. So it's what it is, what's in the EMP in the problem. So it's, we lost 32,000, so that's going to be a negative 32,000. Negative 32,000. Okay? Then we add any gain, if we have any, from step 2. Step 2 gain. Are there any? That should be step 1 / step 2, I should say. Because step 1 is where you actually have the gain, and step 2 is the gain. The idea is that the current EMP comes from the problem, and then you have to add any gain that results from step 1 that adjusts step 2. The reason that we do that is because when you have a lot of stuff going on, like in this problem, it helps you keep everything straight. Well, we didn't have any step 1 or step 2 consequences, so this is going to be plus 0. Finally, the final thing, and this is where things get tricky, and you'll see this in later problems, this can get tricky, is the distribution adjustment. The distribution adjustment is almost always what? Whatever amount from the shareholders was treated as a dividend. And that's exactly what it's going to be here. We look at all of the distributions, April 1st and December 31st. Remember that none of the distributions in December 31st to kiwi or strawberry were considered dividend. But the April 1st, $40,000 distribution, $28,000 was considered a dividend. So we go ahead, and this is always subtraction. We subtract out the amount that's considered a dividend to the shareholders for the entire amount of the year. The only exception to this, when we don't use the amount of the dividend, is if you distribute property, if the corporation distributes property and the basis of the property is greater than the amount of the fair market value. It's the only exception, okay? But we don't have that here. And that gives us the, so we start with the accumulated EMP, the beginning balance. So this gives us our ending accumulated EMP for the year, which rolls over to the beginning of next year. So we go ahead and we do the math. Positive 36,000 minus 32,000 is a positive 4,000 minus 28,000 gives us a negative 24,000. So next year, the accumulated EMP is negative 24,000. And that finishes really problem number 4. Now we're not done because remember I mentioned, yes, this is problem 4, but I mentioned this video also covers problem 5. And you're going to see that problem number 5, it's about to pop up, it has almost identical the same facts. But when it switches over, I want you to stop the video and see what changes. I'll give you a hint. There's only one major fact that changed. Okay? And really, it's only one line that changed. So let's go ahead and look at problem number 5. All right, so here is problem number 5. Take a look and see if you can find what changed. All right, so if you were able to find it, right here, during the current year, Fruit Sushi Inc. lost $32,000 measured by EMP. So that's the exact same sentence from last time. But let's read the next sentence. The EMP was lost entirely. So that lost EMP was entirely attributable to the sale of a single Section 1231 asset, and here's the important part, on February 1st. And ordinary business for the year broke even. So it's saying that that 32,000 lost EMP came from February 1st. There was a sale of an asset where there was a loss that was resulted. Major event. Okay, that's ascertainable. The rest of the year, though, the EMP broke even. So the difference between the last problem is that the $32,000 loss, which is the exact same amount, was ratably over the entire year from ordinary business operations Versus here, the ordinary business operations broke even, but there was one event that's isolated to February 1st where there is a $32,000 loss. So you see how that's going to be a major factor. Now let's go through and let's analyze, because all the other factors are still the same. Same stock basis, same accumulated EMP. Again, the lost EMP is still $32,000. We have those same 3 dates, April 1st, July 1st, and December 31st. Same amounts, $40,000 to Kiwi, sell half the shares of Strawberry, and then the 2 distributions. Everything else is the same except for, again, this line. The EMP loss was entirely attributable to the sale of a single 1231 asset on February 1st, and ordinary business for the year broke even. That's the only thing that changed. Just that sentence. That's the only thing that changed. So let's go ahead and let's do our analysis again. So again, because we have cash distributions, these are cash distributions, step 1 and step 2, right? Step 1 and 2, there's no consequences. We have no tax consequences. Okay, so we can go ahead and go right to step 3 and look at the tax consequences with respect to the shareholders, Strawberry and Kiwi. So remember, within step 3, the tax consequences of the shareholders, we have 3 sub-steps. First, we need to determine the amount of the distribution, and there's no property here, and there's no liabilities assumed, so it's simply the amount of cash. $40,000 distribution on April 1st to Kiwi, $20,000 distribution to Kiwi on December 31st, and $20,000 distribution to Strawberry on December 31st. So all cash distributions. Step 2, we look at the EMP. And remember, when you're doing your EMP in step 2, what you're looking at is you're looking at the overall, the big picture of EMP to see if, okay, what exactly do we need to do to apply specific rules. So the accumulated EMP is positive 36,000, right? That's right here. So that's positive 36,000. And then the 32,000 negative current EMP. So those numbers are still the same, just like we saw in problem number 4. So if we netted those, we get a positive 4,000. But are we just going to simply use the 4,000? Well, again, we have different rules. Current EMP needs to be prorated, and then accumulated EMP needs to be FIFO. So the same analysis, the same ideas apply from problem 4. FIFO for accumulated EMP, and then remember, current EMP is always applied using pro rata. We apply pro rata, including whether it's positive or negative. Okay? Those are the ideas, and that's from the regulations and the revenue ruling. There's a revenue ruling on this as well. Okay? So, to do step 3, the waterfall, we have to know EMP, so we're going to do steps 2 and 3 together. And the way that we're going to do them is just like last time, we're going to go through the dates. So we start with April 1st. We start and we go down again chronologically because of the FIFO aspect, because we do have EMP that's going to be FIFO. Okay? So if you have accumulated EMP and it's positive and you don't have enough to cover everything, you're going to have to do everything chronologically because of this FIFO element from the rev ruling and the regulations. So April 1st, we have a $40,000 cash distribution to K for Kiwi. We're going to separate this off just like last time. All right? Give us some room later on to determine the basis as well, because we have to do all the tax consequences. So we're determining this $40,000 distribution. What amount is considered EMP? What amount is return of capital? And then finally, third is what amount is capital gain distribution. All right. So in order to do the EMP analysis, what we do, just like we did with problem number 4, is we start by taking the accumulated EMP, which is positive 36,000. And then what we did in problem 4, this is where things differ. So in the regulations, in Reg 1.316-2B, that's Reg 1.316-2B, it states that if you have a current EMP that's negative and is attributable to a specific event on a specific date, just like we have here, one event on a specific date, February 1st, you don't do it ratably like we did before, or pro rata, it all goes. So the pro rata rule here is out the door. We look and we say all 32,000 of that loss happened on February 1st. So everything after February 1st, every event after February 1st, we have to take into account the 32,000. And that's exactly what we do. The current EMP, as of April 1st, because we already have this event occurring, is negative 32,000. So that gives us positive 4,000 EMP, and that's all we can use. We can only use positive 4,000. So EMP is positive 4,000. So that means that, again, because these three numbers need to equal 40,000, we have 4,000 here. So next we go to return of capital. So 40,000 minus 4,000, these two numbers, return of capital and capital gain distribution, they need to equal 36,000. 40 minus 4 is 36. So we have $24,000 of basis. That's less than 36. So that means that the return of capital is going to be all 24,000. And that also means that the basis of the stock, adjusted basis of the stock, we start with 24,000. The return of capital number, remember, it's always this number. We subtract away 24,000. That means that after this transaction, Kiwi's basis in the stock is 0. And all the shares of stock is 0. Finally, capital gain distributions, whatever left over. So 40 minus 4 minus 24. So 4 plus 24 is 28. So that means 40 minus 28 is going to be 12,000. 12,000 capital gain distribution. And that's the tax consequences for April 1st. The $40,000 distribution to Kiwi is going to be 4,000 EMP, so that's a dividend, 24,000 return of capital, which is not taxed, but it does reduce the basis down to 0, and then capital gain distribution is 12,000. Now that's going to be long-term capital gain, and that's because the stock has been held for several years. So greater than, or more than 1 year is going to be long-term capital gain. So that's how that works. Now contrast that with the situation we had in problem number 4, where we had ratable, pro rata, negative current EMP. And remember, our current EMP for the year was the EMP total that we calculated was 28,000. So the return of capital was 12,000, and that reduced our basis down to 12,000, and there was no capital gain distribution. So notice the tax consequences are much different. Here, we have a dividend of 4,000 and 12,000 long-term capital gain. In the other situation, we had dividend of 28,000, and then we had $12,000 return of capital. Okay, so see how that works? It makes a difference. And again, the basis is adjusted. That's going to be an impact for later decisions. Okay, so now we go to the next date because we're done with April 1st. We're done with that one. Now we go to July 1st and see how that impacts things. So on July 1st, we have a sale of half the stock for $50,000 to Strawberry, and that's what Kiwi gets. Remember, the tax consequences of Strawberry is simply that Strawberry has a basis of $50,000. $50,000 basis in the stock. Kiwi has $50,000 a sale. Remember, whenever we sell, we have to worry about Section 1001. The amount realized minus the adjusted basis. Amount realized is what Kiwi got. Kiwi got $50,000 in cash minus the basis. We have to take that $24,000 basis, but after April 1st. So that's 0. It went down to 0. So that means the gain, there's a gain here, a realized and recognized gain of $50,000. That's going to be a long-term capital gain because the sale of stock is capital since Kiwi is not a dealer or trader in securities, so it's a capital asset, and it was held for several years. So long-term capital gain. And remember the adjusted basis of the half the stock left, because on July 1st, Kiwi sold half. Adjusted basis of the half of the stock left over equals 0. Equals 0. It's important. It's going to be important for the next part. Okay, so now we're moving along. We're done with July 1st. Again, Strawberry has a basis of $50,000. That's under the cost basis principle. So now we have December 31st. December 31st, we have 2 distributions. We have a distribution of $20,000 to Kiwi, On December 31st, that's 20,000 to kiwi for K for kiwi, and 12/31, 20,000 to strawberry. So remember, that's the amount of the distribution. So we have to determine how much of that is going to be EMP, how much is return of capital, and how much is capital gain distribution. Same thing with strawberry. Have to determine how much is EMP, how much is return of capital, and finally, number 3, how much is capital gain distribution. So let's start with kiwi. So we used up all the EMP. There was 4,000 we netted, right? 36 netted with a negative 32,000 current EMP results in 4. We used all 4 here. So that means going forward, the accumulated EMP is 0. Accumulated EMP going forward equals 0. So that applies with respect to all this. Accumulated EMP is 0 because it's been used up. It's been used up right here. It was all used up, all 36,000, and the current EMP right there, 4. Okay? So EMP is going to be 0 for both of these, right? So the dividend is going to be 0. So now, again, we're focusing on kiwi here. Return of capital, we look at the basis. The basis that kiwi has in that half the stock is 0. So there is no return of capital. So that means that the $20,000 distribution on December 31st, all $20,000 is considered a capital gain distribution, which is going to be long-term capital gain because, again, the stock is held for several years. See how that works? Then we go to strawberry. Strawberry has a $50,000 basis. There's $20,000 of distribution. So that means that all that means that all 20,000 is return of capital. All 20,000 is return of capital and none capital gain distribution. So what does that do? The adjusted basis goes from 50 minus return of capital of 20, $30,000 basis is left over. That's the ending adjusted basis is $30,000. 50 is the starting point, minus 20 is 30,000. A few observations regarding December 31st. Also observation on July 1st. Let me start with July 1st. July 1st, remember the gain was a lot less than problem number 4 because there was $6,000 of basis. It was $44,000 of long-term capital gain. So notice that how that impacts and that changes things. On December 31st, notice a few things. There was no EMP in either situation in problem 4 or problem 5 with respect to December 31st. So that's, okay, we understand that. That's because in problem number 4, more of the rateable current EMP that's negative was applied toward the end of the year. That's how that worked. With respect, and there was no more positive accumulated EMP, so there was nothing there. So actually, EMP would be negative at that point, right? But we said 0 because that's the amount of the dividend, right? That was the amount of the 0 dividend. So remember, in problem number 4, for kiwi return of capital, there was some basis left over, 6,000, and then 14,000 capital gain distribution. Look here, all 20,000 because there's no basis. And then after this distribution, the basis remains 0. It still remains 0 because, again, there was no return of capital here that was recovered. Strawberry, notice strawberry though. Strawberry has the same exact situation. 0 and then 20,000 return of capital. That's because strawberry's basis is just so high. So problem number 4 versus problem number 5, strawberry's tax consequences are the same. $30,000 adjusted basis, 20,000 return of capital, same situation for both of those. Kiwi is what changed here. Now, you're going to see that in step 4, the corporation is going to have some tax differences as well because of the amount of EMP. So we got to look at that as well. Okay? But one thing I want to note is if strawberry, this is something to think about. What happens if strawberry had capital gain distribution here? What would the tax consequences be? Think about it. Well, remember, when you have capital gain distribution, you have to ask, how long has the stock been held? Well, strawberry's only held the stock as of December 31st for 6 months. July 1st to December 31st is 6 months. So if strawberry did have a capital gain distribution, it'd be a short-term capital gain, which would be treated as ordinary income if there's no other capital losses to offset it. Very interesting. Okay, So now let's go and look at the final step, step 4, because step 4 also changes. So step 1 and step 2, again, no consequences, just like in problem 4. Step 3 changes for kiwi, stays the same for strawberry. That's what we saw there. Step 4 will change. So now we're going to take a look at that. I'm going to keep this area over here the same because this is the only area where we had EMP, which means dividend. No other dividend or EMP, right? So we need to know that $4,000 number. So now let's take a look at step number 4. All right, so we're almost done. So again, step 4, what we're doing is we're adjusting the accumulated EMP for next year, and you will see that will be different from problem 4. Problem 5 will be different from problem 4. So adjust accumulated EMP in step 4. Remember, we have our friendly formula that we use. This helps out tremendously. We start with our beginning accumulated EMP for the year, which here we're told is positive 36,000. And then we add or subtract depending on the current year EMP. And again, this comes from the problem. This is not from any of the steps. This comes from the problem. So here we're told that the current year EMP is negative 32,000. Negative 32,000. All right. Then we add step 1/step 2 gain. So really step 1 is where you recognize the gain of the corporation, but step 2 is where you adjust the current year EMP. So here there were no consequences to step 2. So that means that we're going to add, it's going to be plus 0. Finally, this is the important part, we subtract away the distribution adjustment, which remember is almost always going to be what? It's almost always going to be the amount of the dividend. The amount of the distribution that is a dividend with respect to all of the shareholders. So the only distribution, right, there was 3 distributions. 1 on April 1st, 2 on December 31st. The December 31st, neither of them were considered out of EMP, so they weren't dividends. The one on April 1st was a dividend distribution. I'm sorry, there was a distribution that was considered dividend. It was 4,000. It was this amount right here, the EMP. So this amount is the amount of the dividend. So we go ahead and we subtract 4,000. Recall that the only time that this will not be the dividend, again, is if it's a property distribution where the basis is greater than fair market value. That's really the only time that you'll see that that's going to be different. But you should always use that as a general rule. And that will give us our ending accumulated EMP. That's the formula. That is the formula. That will give us our ending accumulated EMP. So we go ahead and we calculate that. 36,000 minus 32,000 is 4,000 plus 0 minus 4,000. Look at this. Accumulated EMP for the year is 0. And that makes sense because at the first transaction, we already took into account the entire amount of the lost EMP for the year, so it was pretty much netted. So I hope that you've enjoyed this video. Please make sure to go over this multiple times. A lot of stuff here in problem 4 and problem 5. A lot of helpful stuff. And it really does help you understand. So now what you've seen is from the problems, and again, through the various problems, you've seen a situation where accumulated EMP and current EMP are positive and there's enough EMP to cover. You've seen a situation where what happens if accumulated EMP is negative and current EMP is positive. And remember, we use current EMP and we ignore accumulated EMP. You saw a situation where accumulated EMP and current EMP were both positive, but there wasn't enough to cover all distributions, so we had to do the pro rata for the current EMP, and then for the accumulated EMP, we did FIFO. And finally, now you see what happens when you have positive accumulated EMP and negative current EMP. The only other situation you can have is when accumulated EMP is negative and current EMP is also negative. If that's the case, then you're never going to have any EMP because the total EMP is going to be negative. The total EMP will also be negative, so when you do your distributions, then all the EMP will be 0. So that means none of the distribution will be a dividend, so you'll have to go right to return of capital and capital gain distribution because there is no EMP to use. But then when you do your adjustment for the ending accumulated balance, you just simply plug in the numbers, beginning accumulated EMP, you use the formula. Plus or minus will be negative current EMP plus any step 1 or 2 gain, and then minus the distribution adjustment. So that's how things work. And distribution adjustment would obviously be 0 because there's no dividends that are in that problem. So that's really everything that deals with these specific items. There's going to be more problems on the corporate distributions, but that really helps you go through the different situations with respect to when current EMP is positive or negative and accumulated EMP is positive or negative. So I really hope you've enjoyed these videos.